Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, President Trump's sweeping tariffs take effect. We'll break down the impact on investors, the global economy, and get a look at the deals that are still in limbo. Plus, Apple increasing its commitments to the U.S. in an effort to avoid tariffs. Will this change Wall Street's outlook for the company? We'll discuss with Needham's Laura Martin. And Eli Lilly shares fall as its weight loss pill data overshadows a sales beat. We'll discuss that and much more on Market Catalysts. Let's get a check of the markets here. We are seeing the major averages gain across the board. Gains being led by the NASDAQ here, which is up by 1.1%. The S&P 500 up a 0.6%, and the Dow gaining about 39 points, or about 0.6%. Take a look at the bond market as well. The falling odds of, or I should say rising odds of a rate cut in September have been pushing down the yields here right now at the 10 years at 4.23%, but not seeing much change in yields across the board. Well, sweeping reciprocal tariffs across some of the U.S.'s largest trading partners are now in effect. Wolf Research found that effective tariff rate just over 16%, representing about $58 billion. That's compared to just 2.8% at the start of the year. Joining us now to break down what we know so far and what is still unclear, Tobin Marcus, Wolf Research head of U.S. policy and politics, and Yahoo Finance Washington correspondent Ben Werschel. Ben, give us sort of a roadmap of where we are right now, where we stand, and what's still to be determined.
Yeah, there's a lot in both of those columns. Quickly on what we do know is we do have, this is a real significant piece of Trump's trade agenda that's now in place. We have headline tariff rates of 10 to 50% on nearly every country in the globe. And as you mentioned at the top, the overall effective tariff rate in the high teens. These are 1930s levels of tariffs overall when you go across every good. So this has been the kind of the centerpiece of Trump's trade agenda. And I think it's worth noting this morning that this is kind of along the similar lines of what Trump attempted to do in April, but had to pull back from. And what we've seen is it's gone forward overnight, and we're seeing it's only one of a variety of market stories this morning. In terms of what we don't know, that's a longer list. I'll focus on one and then let Tobin add into the others. But I think the sectoral tariff piece of this is really significant to watch as a key unknown, because essentially I think we've actually had less clarity over the last 24 hours on that front. Trump made some news last night saying he's thinking about 100% tariffs on semiconductors. That would be a major change if that did go through, but there's reasons to be skeptical there. For one, he talked about a carve out even for companies who have a commitment to build in the United States could dodge this, as well as the fact that deals with the European Union and South Korea seem to exclude them and give them a 15% rate on semiconductors. So that's a big kind of uncertainty that is set to be resolved in the coming days, as well as autos and pharmaceutical tariff, both of which have a lot of loose ends there. So that's one of the big unknowns. There's a whole long list as well.
There is a whole long list. Tobin, is that a problem that there's a whole long list? As we know, we've been talking about for days how markets don't seem to care. So how big of a deal is it that there are still so many unanswered questions?
Well, it certainly doesn't seem to be a problem for markets, which I think a lot of investors have gotten pretty well habituated to looking through this. Anecdotally, the sense that we get from a lot of more fundamentally oriented institutional investors who we speak to is tired of losing money guessing wrong what's going to happen on tariffs. We're going to try and look through this as best we can. I think that means that we're going to start seeing markets react to this when it's reflected in company earnings rather than trying to kind of look around corners and react to the headlines and the modeling of what the impact is going to eventually look like. But we do think that impact is still coming. It's starting to materialize. We saw that in Q2 earnings for a lot of companies. We're starting to see it in inflation data. But our economics team at Wolf Research has found that only about 30% of the total tariffs have been absorbed anywhere that we can see, only about 10% absorbed by foreign supplier pricing. So we think as we get into this steady state, as companies sort of know what they're executing against, know what they need to absorb, we're going to see them passing through prices more. We're going to also start to see that continue showing up in margins. And so, we think it's a headwind, not something that's going to break the back of the market on its own. But we do think that there's a lot of impact here that's in the early stages of showing up. And
how about these sectoral tariffs, right? Especially on semiconductors, from what the president seems to have indicated yesterday, seems like there's going to be an awful lot of companies that get exemptions.
So it remains to be seen how broadly and liberally, the president is going to define companies that have committed to investing in the U.S. It sounds like probably fairly broad. I think a lot of the big companies that people care most about will be able to get themselves exemptions. Apple and NVIDIA have been very, very savvy and public about doing this. But there are a lot of companies in that space that have at least some amount of investment in the U.S. And those that don't, of course, are going to make a show of trotting out everything they're already doing, everything they can see they're planning to do, and try and get those exemptions in the near term. That being said, the universe of products that's hit by these semi-tariffs is potentially very, very large. I mean, the direct imports into the U.S. of chips are fairly small, in the $50 billion a year range, in terms of what's been carved out from the reciprocal tariffs for that reason. But then there's this larger concentric circle of consumer electronics that contain chips, which is about $450 billion. And I think that's a fairly diverse ecosystem. It's not just a few big companies. I don't think that everyone is going to be able to get themselves exemptions. So in aggregate, I think we're going to see a pretty significant impact here, that may show up in consumer pricing, even if it's not showing up in the earnings of the sort of biggest, highest profile companies in this space that investors are focused on.
And Ben, we haven't really talked about China that much, but obviously that's still outstanding as well. What's the next thing to watch there?
Yeah, that was actually next on my list of kind of big unknowns here. We have a deadline there of next week, August 12th, for China, for at least an extension of China tariffs. If there's no action there, they would potentially jump back to triple-digit levels. What we've been expecting all week is positive signs. We saw some new commentary this morning from Trump aides along these lines that another 90-day extension is in the offing as the overall focus here is to try to get a Trump-Xi meeting on the books in the fall. But again, we've been waiting for a whole week on this, and then as we're getting closer and closer to this August 12th deadline, I think there's going to be increased focus there in the next couple of days, whether or not Trump agrees to this additional extension.
And then, Tobin, as you wrote about recently, there's still the possibility of legal challenges for all of this. What likelihood do we put that at?
So based on the oral arguments in front of the Court of Appeals for the Federal Circuit, which is the appellate court hearing the main case here, that happened last Thursday. That panel sounded extraordinarily skeptical of the government's arguments. It's also a panel that leans Democratic in its composition. 8-3 Democratic appointees versus Republican appointees. So our fairly strong base case is that at the circuit court level, they're going to agree with lower courts that these tariffs are illegal under what's called IEEPA, the emergency economic authority the president used for the reciprocal tariffs and for the fentanyl tariffs on Canada and Mexico. Then it's going to go to the Supreme Court. We expect a decision close to the end of the year. My narrow base case would be that the Supreme Court upholds those tariffs, but I think they're going to be pulled in opposite directions. They tend to be this court's jurisprudence has been skeptical of sort of sweeping assertions of power under ambiguous statutes. On the other hand, they're going to be, I think, very loath to second guess the president on what he's characterizing as being a national emergency. So I think they'll be pulled in both directions. Could go either way. I think there is a real possibility that these tariffs do get struck down by the Supreme Court, in which case the tariffs already collected over the back half of this year. A lot of those companies are going to be able to file for refunds, which is going to create some pretty choppy macroeconomic landscape next year if it goes that way, and could be a windfall for some major importers.
And when we talk about what markets have priced in, they certainly don't seem to have priced in that could happen, right? So that I would imagine that would create quite a bit of volatility and turmoil if you see all of that play out, right?
I think that's right. This is an underappreciated possibility in my view, based on the conversations that we're having across the buy side. People, of course, know the litigation's going on, but I don't think there's a lot of conviction about the outcome of the litigation. And then, again, assuming that the tariffs are struck down, not our base case, but a real possibility, there's both the question of what happens prospectively, where I think the president is going to be able to recreate the same pattern of tariffs under alternative authorities. So you're not necessarily getting long-term relief in the run rate. But then there's the question about, again, what happens to the potentially hundreds of billions of dollars of revenue that have been already collected under what will turn out to have been unlawful tariffs in place this year. So I think you'll get choppiness in terms of the prospectively applied run rate of tariffs, and then this question about whether or not some of that money can be disgorged by the government.
Bottom line, still a lot of questions wherever you look. Tobin, Ben, thank you. Appreciate it. We got more markets action coming up, including talking more about Apple's commitment to invest in the U.S. and what that's going to mean for its tariff rate. You're watching Market Catalysts. Apple CEO Tim Cook joining President Trump at the White House Wednesday evening to announce the company's plan to invest another $100 billion into the U.S. on top of the $500 billion it pledged earlier this year. The company's looking to avoid painful tariff pressures, bringing more of its supply chain and advanced manufacturing to the U.S. We want to get an analyst take on this investment with Laura Martin, Needham & Company senior media and internet analyst. Good to see you, Laura.
Hi.
So I've seen some analyst commentary this morning that the way Tim Cook handled this was masterful, right? He presented a gift to President Trump, like a little statuette, I guess you would call it. You know, I'm curious to get your take on this and how you think Cook has sort of finessed this situation.
So I wish they'd started at 200 million the first time. So when he raised it by 100 billion yesterday, it would have been 300 instead of 6. But I think this is a way to buy down tariffs currently from India and China and get an exemption for Apple, while promising to spend money over a 4-year term that if it ends up going past Trump, they may never have to actually deliver on.
Well, that was going to be my question here. You know, do they actually spend this money? What do they actually spend it on? Or is this indeed sort of a waiting game?
So I think they've already made commitments, and we saw a couple of the companies that they announced yesterday in Texas saying, hey, they just got a $2.5 billion deal with Apple, like they just signed it, because Apple has to go in and sign contracts with all these people. But these are $2 billion contracts, and they just committed $600 billion over 4 years. So I think they're going to have trouble spending that much money in America over the next 4 years. But the more important question is, are they going to get tariff relief from India and China? Because it'd be horrible if they didn't. And that was hurting the prices of their iPhones today. And yet they have this horrible commitment to spend all this money, which will increase the cost of iPhones, frankly, over the next 4 years.
And so I guess there's no way of knowing if they're going to get that tariff relief. And your sort of like backdrop for this stock, I know you have a hold rating on it right now, is that, you know, there has to be an iPhone replacement cycle. I imagine an iPhone replacement cycle is not going to be helped if iPhones get more expensive.
Correct. Our estimate is that if they moved all of the manufacturing and assembly to America, iPhone prices would triple. And they start at like $1,200, $1,400 per iPhone. So like it's sort of uneconomic to bring a lot of the assembly back to America. But I understand that they really do need to get tariff relief right now for the new iPhones that go on sale in September, starting in September.
And do you expect that they will also take a hit to margins, or is Apple able to pass on maybe all, if not most of that cost?
I believe they will pass on all of the costs and they will not take a margin hit.
And so, given all of that, you've got this hold on the shares. What would convince you to get more bullish? Would it be if some of this macro stuff went away?
No. I believe that for the stock to work, they must have an iPhone replacement cycle, which is in their control, in my opinion. So if they did something really interesting with generative AI, if they bought an interesting company, a foldable phone would be interesting to me. So something that makes it more likely that all of us go out and replace our iPhone, because every year they don't convince me to buy a new iPhone. My iPhone gets older, and Android, as you know, is backed by Google, and they are putting generative AI into every product that empire has, including Android. And they are going to be doing really innovative things. So my iPhone, as it gets to be 4, 5, and 6 years old, and iPhone doesn't convince me that I need to replace my iPhone with an iPhone, it buys time for Android to improve and do interesting things that Apple isn't fast following Android into.
You know, Laura, something I've been asking everybody I can who follows Apple about is why it's so important for the AI to be native to the phone. In other words, if most of the functionality on my phone resides in the apps, why is it so important for Apple to have this AI strategy if I'm just going to use ChatGPT or Perplexity or whatever else on the phone anyway?
Right. So 2 answers. One, for Apple specifically, privacy is their gig. So they want to control the AI applications so that they can lock down privacy and make sure your data isn't being hacked or you're not being tracked by a foreign country. That's Apple's answer. More importantly, the bigger answer is Android, to the extent the Android ecosystem is going to use generative AI on your phone writ large, it is going to track and suggest, do you want me to call you an Uber? Would you like to go back to this restaurant? Or there's a higher rated restaurant nearby. It is going to look at your behavior across apps. This is Android now. And it is going to suggest things to you and push things to you and give you discounts that, because it's looking at every behavior. An iPhone iPhone is 5 hours, Android is 4. But the best upside of using generative AI, in this case on an Android, and where they will be first, is looking across all your behaviors on your smartphone and then suggesting things to you that make you more efficient, more productive, have a higher value for you. That's the promise of generative AI across the entire ecosystem.
Okay, that one makes sense to me here. Laura, while we have you, I want to talk to you about Warner Brothers Discovery, because that company came out with its numbers. The shares are popping as it saw some successful movie releases driving that 55% increase in revenue. It also added a lot of global streaming subscribers. Of course, the company's preparing to split into two, and it did see slowing continued slowing in its linear TV networks. So what do you make of that one? And are you awaiting this split as something that is going to unlock that value for the company?
No, the split's not going to happen till the end of 26. So you can't buy these shares. We have a hold here. We can't buy these shares today on the split, which is happening a long time from now. Look, total revenue here was up for the whole quarter, for the whole entity, was only up 1%, which was better than our estimates. Their EBITDA was up 9%, and their EPS, they did a 63-cent positive EPS, up from a loss of over $4 last year. So profitability metrics really solid. We have changed the name of HBO Max back to HBO Max, and strong streaming numbers moving into profitability. So I would say that the Warner Brothers numbers were better than we expected. But meanwhile, this is a no-growth company. And strategically, it has very good film numbers, absolutely being buoyed. The results are being buoyed by films. They just announced their 5th consecutive box office over 45 million of domestic box office in a row. And Superman is a huge hit for them. And they did say on the call that their focus, they're sort of slow following Disney. Their focus going forward is going to be on tentpole films coming out of all 4 of their studios. But DC, which has been really an underperformer compared to Marvel over at Disney, these guys, like Superman, is the first, I would call it, unmitigated success out of the DC empire. That's my opinion. And he's saying they're going to do 2 or 3 of those tent poles a year from across all 4 of their studios. And I think that's a good strategy. They also specifically spoke about the multiplier that Disney gets. So for that is, they get 30 cents for every dollar of box office gross they do. Disney gets $1 of other revenue for every dollar it gets from the box office. So the Zaslav empire is going to really focus on getting more merch, more money out of a park license fee idea, more ancillary revenues coming out of each of their tentpole IP franchises. That's a smart strategy.
Gotcha. So we should expect more Superman stuff coming our way to buy in addition to that movie. And then finally, quickly, I want to ask you about Paramount Skydance, because that merger was just completed, the $8 billion merger. PSKY, I believe, is going to be the new ticker of the merged entity. How should investors be thinking about that one now that it is finally done?
Oh my God, I thought it would never end.
Yeah.
So we have a new CEO and we have a new trading ticker today, PSKY. We have a new CEO, David Ellison, the son of the notorious billionaire. And we have a new vision, right? They're saying they're going to bring generative AI technology into Paramount Plus. That's interesting. I don't know what it means, but I'm very interested. They're going to cut costs by $2 billion and immediately pay down $1.1 billion of debt, which helps get the leverage numbers down. That's a big positive. And I think we just need to, unfortunately, I do think it will leave the S&P, because I think it's an $11 billion cap business. So I think it won't be in the S&P, which is unfortunate. But I think we need to there's a new vision here. We've got a new management team, very excited to hear what they have in store, but most excited to hear how sort of a younger management team is going to integrate technology into a traditional streaming business, maybe faster than any other streaming business out there, actually.
Interesting. Yeah, it feels like that's where things are going. So, Laura, I'm looking forward to catching up with you once we get more details on that. Appreciate your time today. Thank you.
Thank you.
Thanks. We got much more markets action coming up. We got trending tickers for you next on Market Catalyst. Now time for some of today's trending tickers. We are watching Peloton, United Airlines, and Crocs. First up, Peloton. The struggling fitness company projected a sales decline for the current quarter and said it would once again cut jobs. But the company preached confidence in a turnaround plan under new management. Under new CEO Peter Stern, Peloton looking to turn around its operations with continued cost cutting, new products, and infusion of artificial intelligence for more personalized workouts, and a deeper focus on initiatives related to cardio. Stern promised investors new product launches before the end of the calendar year. Next up, United Airlines dealing with a software outage across the U.S. It temporarily grounded planes across the U.S. and delayed more than 1,000 flights. The airline said the underlying technology issue has been resolved, and while residual delays are expected, the team is working to restore normal operations. The outage involved United's Unimatic system, and it was not related to recent instances of cybersecurity issues in the airline industry. That's according to a United spokesman. Finally, Crocs sinking by the most since 2020. The shoe company said tariffs and its efforts to save money amid consumer pressure would drive down revenue. On the earnings call with analysts, Crocs said it would not be reinstating full-year guidance at this time due to changing global trade policy. Crocs imports from countries highly impacted by tariffs. The company will focus on managing its expenses, including cost savings, inventory reduction, and a pullback in promotions. Those shares down 25%. And as always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Eli Lilly shares are sinking after disappointing data for its highly anticipated weight loss pill that's overshadowing the drug maker's strong second quarter results and upbeat guidance. Joining me now, Evan Siegerman, BMO Capital Markets Managing Director for Biopharma and Yahoo Finance Senior Health Reporter Anjali Khemlani. So, let's start with you and let's talk about. Let's leave the earnings aside for a moment because obviously it's trading on these this new pill news. So just tell investors, tell viewers what they need to know about the results of that data.
Yeah, just a quick recap. Eli Lilly gave us the results of a late-stage trial looking at that pill, orforglipron, 11% weight loss, which came under what the street was estimating and hoping for, especially as you're looking at the competition between Eli Lilly and Novo Nordisk in this space. They've already been head-to-head in injectables, Lilly leading the pack. And so the expectation was that Lilly's drug would then result in greater weight loss, just like its injectables do. You can see on your screen that also about a quarter of patients dropped off at the highest level, and that's sort of where investors do have some concerns. What caused that? The executives seem to kind of brush it off, saying that's within the window, expected, and they're not worried about any of those drop-offs because there were no major serious adverse events. Meanwhile, we also did hear from Novo Nordisk's CEO, the new CEO in place, Mike Dutzer. It's really interesting to hear that commentary because we've seen this company be very quiet in this race, and this seems to be a significant strategy shift. He sent a statement to Yahoo Finance, quote, subject to a favorable FDA decision, Wegovy will be the first oral GLP-1 for weight management in the market, and the data demonstrated that Wegovy has a 16% reduction. So the battle is clearly on. We thought, a lot of people thought that it was Lilly's for the taking, but the battle continues.
Yeah, and becoming a little bit more explicit, that battle, with that commentary there. Evan, what do you think here? How much of a setback do you think this is for Lilly?
Well, clearly this is a setback because our expectations were that it would look like Wegovy, so say 15% or so. And I think that investors wanted to see that because that was going to make them competitive in all aspects of the market. The sleeper, definitely high-dose oral sema, 25 milligram sema, oral Wegovy, if you'd say it. 16% weight loss is fantastic, and I think that's really potentially could drive expansion in the oral market. We'll see what happens with manufacturing, but I suspect Novo will be up to the challenge. One thing I do want to note, though, is with the two products, orforglipron can be taken with or without food. You have a few limitations with the high-dose oral sema, but that weight loss is what people are looking for.
And so where do we go from here? I mean, we see that Lilly is down 14% today. Novo's gaining, right, on this. So what is the next thing to sort of look for, Evan, on this front?
Well, we're going to get another trial attained too. I think folks pretty much have their expectations built in at this point. But really what I'm focused on are the strong 2Q results. That's what's key here, because those results and kind of the outlook is what drives the financial performance of these companies. The fact that Lilly beat on both Zepbound and Mounjaro, and of course raised guidance where Novo did not do that, I think that's a bullish indicator. Still, as we think about what the oral market looks like, we have to think that Novo is going to take share, and that could be the issue. But I'm still bullish on Lilly. I think that their commercial execution is supreme, and I think that orforglipron remains a viable drug and will be used in many patients.
And on Evan's point, second quarter sales for Lilly up 38%. It also raised its forecast for the full year. So when it comes to the numbers themselves, what else stood out to you?
Yeah, I think that looking at how much the GLP-1 drove growth, right? Both Mounjaro and Zepbound, you're looking at $10 billion in the quarter from the U.S. market alone. That tells you everything you need to know about how much Eli Lilly's portfolio, despite being broad and diverse, despite it being, one of the largest, if not the largest pharma company right now, still with that large market cap. And even though it dropped off from that race to $1 trillion, it certainly is looking at those GLP-1 drivers and continues to lean on that, even as it has its other products sort of standing out. And so the fact that it can raise almost more than $1 billion compared to what the street was expecting, I think that also fits sort of the story and to what Evan's talking about with the strength of Lilly.
Evan, historically, when you look at these kinds of franchises, eventually it sort of tapers off, or eventually at least it gets priced in. What do you think is the sort of runway for this new class of drugs that has been so touted as being transformative?
For sure. And I think that there's definitely been this halo effect and this excitement around the potential for these products. But going forward, the commercial side is very important. I think what's key is the ability for these companies to drive volume, because pricing is not where they're going to gain their revenue increases. So the volume is going to be critical. That's why we wanted to see expansion into the oral market, which they're both going to get. Looking ahead, I believe that we're going to have the obesity duopoly. I'm still bullish more on Lilly because they have assets outside of obesity. We're excited about a potential use of Kisunla in pre-symptomatic Alzheimer's. They have cancer assets, they have inflammation assets, which allows some diversity, not necessarily kind of the key part of the story now, but diversity in the revenue base going forward.
And Anj, where are we on the insurance question when it comes to many of these GLP-1 and obesity drugs and how that feeds into the story?
Just like the GLP-1 market, it's a mixed picture. And just like in insurance market broadly, they do pop in and out of various markets. It's the same story for GLP-1s. We've seen that majority of employers continue to want to cover that, so that hasn't been as much of an issue. There you do have some drop-offs, but that has been sort of the interesting part of the story, because at the same time you also have the government pushing for coverage and a little bit reversing course from what was said earlier this year. You've seen the Trump administration kind of take a look at whether or not they can include coverage for any of the government funded insurance coverage. Meanwhile, in the private market, we're seeing very differing sort of situations with different insurers taking on a different view. You have more of the private ones taking them on. Meanwhile, Blues and others may be a little bit more cautious about coverage when it comes to weight loss. But of course, diabetes continues to be covered.
And Evan, is expanded coverage really the key to unlocking, along with the pill, is that the key to unlocking more volume for these companies?
Most definitely. And I'm definitely focused on the potential expansion into Medicare. The Trump administration had highlighted a potential demonstration project to get coverage for anti-obesity meds in the government program. I think the cash pay segment is also very critical because Zepbound vials drove a lot of the commercial performance this year or this quarter. Novo's also talking about that. So we'll see how that plays out. I could see orforglipron and potentially oral sema be drivers of the cash pay segment, where patients may not have great insurance coverage or any insurance coverage at all, getting that discounted price, and access via telehealth.
This continues to be such a fascinating story to cover. Evan, Anjali, thank you so much. Appreciate it.
Thank you.
Much more markets action coming up. We're going to dig into earnings from DraftKings with the CEO coming up. DraftKings beating Wall Street estimates in its second quarter. It also reaffirmed its full-year outlook, new customer acquisitions, and positive sports outcomes boosting revenue. Joining me now on the report and the state of the sports betting industry is Jason Robbins, DraftKings CEO. Also joining us, our Yahoo Finance senior markets reporter, Josh Schaefer. Jason, thanks for being here. It's good to see you. Looks like it was a strong quarter for you guys. I'm always curious when you have positive sportsbook outcomes, how sustainable that is, because that is a matter of games going the way that is more favorable to you. So, you only have so much control over that. So what do you foresee for the second half of the year on that front?
Oh, I mean, we have no control over that. So, sometimes it swings this way. Last couple quarters, it went the other way. So we'll have to see where the rest of the year goes. Obviously, we're doing our best to pinpoint what we expect the margin to be, but there's always a little bit of variance based on the sporting events themselves. And that's what makes it exciting is, sometimes you don't win, but sometimes you can win. And last couple quarters were big winning quarters for customers. And this time in Q2, it swung our way. So I'm sure at some point it'll swing back to the customer too.
So Jason, what can you tell us about the second half of the year in terms of what you can control and the outlook for the full year?
We're really excited about our product. I think our sports product is especially great on the live betting front. We made a ton of advances to our parlay offering. We like to say our product is moving at the speed of sports right now, and sports is obviously always happening, and so there's always something you can bet on anytime on DraftKings, even during the games. So really excited about that. Our iGaming product is advancing rapidly. Back on the luck front, we haven't had any big jackpots for lottery, but hopefully we'll get some big ones in the back half of the year, and those are always the best moments for our Jackpocket brand. So lots of exciting things on the horizon for all of our products, and I also think we have some really great marketing campaigns lined up for the fall. It's our busiest time for customer acquisition, given all the sports, and especially NFL, is really the biggest source of new customers.
Right, of course, big season for you guys. I want to kick it on over to Josh here because Josh, I know that you're watching one of the important metrics for DraftKings that did well this quarter.
Yeah, taking a look through the release, Jason, I mean, average revenue per user, per monthly user, I believe was at an all-time high at 151 per user. It's been ticking up over the last couple of quarters. I guess I'm curious, you mentioned live betting, which is of course betting during the game, right? You mentioned parlays, so bundling bets and betting on multiple outcomes. Is that what's driving more revenue per bettor, is the fact that people are betting on some things like parlays in the live betting, or what's sort of pushing that metric?
Those are definitely drivers, and for sure the growth in live betting has been great for us, and the growth in parlay has been great. Not only is it growing our volume, but also helping our hold rate. But also some of that was the positive sport outcomes too. That was obviously a big factor as well. So it was a combination of things really.
I also want to ask you, as always, you guys are subject to what's going on with regulation nationally and state by state. And I know there is this new Illinois tax. Can you talk us through how you guys are thinking about it and what that's going to mean for gamblers in Illinois?
Well, the challenge with the tax is it's not a percentage of revenue, it's a per wager tax. So, whether you're betting 25 cents or, $1,000, it's the same 25 or 50 cent charge depending on your volume. So really the challenge for us is we don't make a profit if we do not pass that along to customers, especially at the lower betting levels. Think about it this way. If somebody makes a $1 bet, they're generally going to get back about 90 cents of that bet, in winnings on average. And so we can't make a profit with 25-cent surcharges. So, tax charges on that. So, I think hopefully this was done very quickly in Illinois. I think there is some appetite to maybe revisit the framework because there are some downsides. We've chosen to pass along the charge to the customer. Some other operators I've seen have raised their minimum bet limits to be $5 or $10 or even higher. that either one I don't think is a great solution. We decided to do what we did because we felt like at least giving the customers at the lower levels a choice of whether they wanted to pay it or not was better than just not letting them bet at those levels. I am worried that's going to drive activity to the illegal market and really, those places don't pay any taxes or have any protections for consumers. So definitely a little worrisome the way this thing was implemented, but hopefully there'll be a fix coming. And in the meantime, we'll do the best we can to offer the product that hopefully everybody feels is worth paying an extra 25 or 50 cents for.
And then, Jason, quick follow on that. Do you expect then your volumes to fall in Illinois once this does get instituted? And are you worried about other states instituting similar taxes?
We really don't know in terms of volumes. This is an uncharted territory type thing. Nobody's done this type of tax before, so we really don't know. I don't think other states are considering it. I think there's been a lot of, questions about what you just asked. How is this going to affect consumer behavior? Will it drive volume to the illegal market and therefore maybe have more harm done than good? So I think other states are probably watching to see. We'll find out. But right now it's anybody's guess because this is an unprecedented thing.
And Josh, I want to go back to you on prediction markets, which I know is a big topic for Jason and just in general. And we here, focused on finance rather than sports, have paid more attention to prediction markets because they ask questions there like who's going to be the next Fed chair. But Josh, I know it's something that you've been following closely too.
Yeah, Julie, we've been following some of those markets like a Poly Market or Kalshi, right, and how they're impacting sort of the economy or being able to bet on the economy. And Jason, I'm curious, it mentions in the release that the full year guidance doesn't include the launch of prediction markets. So, I mean, where is the launch of prediction markets? And then to Julie and I's point, what kind of markets would be available if you did launch a prediction market? What would people be able to bet on the outcome of?
Oh, I think it's premature. I mean, the reason we put that in there is we've been getting a lot of questions about our plans, and people were going to ask on the call if it was in our guidance or not. So we figured we'd head that one off at the pass and say, no, we didn't include anything like that in our guidance. And I think that's a reflection of where we're at, which is we don't have any definitive plans and any definitive timelines. This is obviously something we have to monitor closely and something that we have to pay attention to and have different options of how we might choose to either be involved or not. But at this point, we haven't really made any firm decisions. And I think the best thing for us to do is to sit and watch and see how some of it plays out for a little bit.
Given that, there has been some reporting that you guys might be interested in making an acquisition into that space. Can you tell us anything about how you're thinking about that possibility?
Well, we're, as we always do, we're talking to a lot of different companies and stakeholders and people in the space to get educated and understand, different perspectives. So I don't think at this point we have any firm plans on anything, but we are in the process of getting educated. And in that course, we're talking to many different companies and also many of our state, regulators and other stakeholders as well.
Maybe we'll look on the prediction markets and see what they say about the chances of you guys getting into prediction markets. I don't know. Jason Robbins, thank you so much, and our own Josh Schaefer. Appreciate it.
Thank you.
Coming up, President Trump's team reportedly has a top pick for the next Fed chair. We got the details next. Federal Reserve Governor Christopher Waller has emerged as Trump officials' top pick to replace Fed Chair Jerome Powell. That's according to a report from Bloomberg. Waller has met with several members of the administration. He's not yet spoken with President Trump himself, though. Of course, it's not a done deal. Kevin Warsh, a former Fed official, and Kevin Hassett, currently Trump's National Economic Council director, are reportedly both still in the running. Joining me now, Ben Emons, FedWatch Advisors founder and chief investment officer, and John Hilsenrath, StoneX senior advisor and Yahoo Finance contributor. It does seem like, and there was some reporting from the Wall Street Journal today, that the administration is leaning towards appointing someone to fill Adriana Kugler's seat that could then move into the Fed chair spot. Ben, I'll start with you. What do you make of this latest reporting on Waller sort of maybe being the front runner, at least today?
Yeah, I think that he is a front runner, but he has said himself that because the president hasn't reached out to him, he doesn't know for sure. And, he really wants to do the job. So he's clearly keen to do it. But it's all the speculation around his actual chair. I think it's by far not determined because they have to fill the Ariana Kugler position first, which is kind of procedural, how they have to go about it. This new Fed chair or Fed member will be only in place for October meeting, not the September meeting, because of the specifics of the Senate confirmation. Yet that position is key because it's an additional vote at the table for cutting rates. And it looks like a lot of Fed members are already like moving in the direction of like, we'll probably have to lower rates in September. So it just only fuels more the rate cut speculation, I think, this debate about who will be the next chair. But who will it be, that's, I think, still a guessing game. And Trump has his time. Right? I mean, once he puts the replacement of Kugler in place, he could take his time. That's being reported.
Right. And John, what do you make it? I mean, it feels like the market is relatively comfortable with a Warsh or a Waller potentially in place here.
The market seems very comfortable with a lot that's going on in the macro setting right now. Stock prices are rising, interest rates are low, but I don't think that the drama over this succession is going to end very quickly. And today we get a headline that it's Waller. Tomorrow we might get a headline that it's Warsh again. I'm really going to believe it when I see it, especially when the president hasn't had one-on-one time with Waller. Let's not forget that Jay Powell was a sitting Fed governor that the president chose, and he ended up becoming very unhappy with Jay Powell. The president said something the other day that sometimes you think someone is great, and then he gets in the job and you're not so sure. So I think that we're moving into maybe the second or third round of this apprentice campaign, and there might be 10 episodes before the season is over.
I mean, Ben, does it, what we were saying here about the changing expectations for what's going to happen with rate cuts, does that make it not moot, certainly, who is the head of the Fed, but the whole politicization conversation, it seems like that comes off the boil if there are real economic underpinnings and reasons for the Fed to cut rates, right?
Yeah, I think so, Julie, because it is a story about inflation and unemployment ultimately. So the reaction to this jobs report on Friday is telling. The Fed is quite concerned if the unemployment rate goes up too quickly and will act faster than if inflation were to go up a little bit. Then they just sort of wait and see what happens with inflation before they do anything. So it is really a point here where we may repeat what happened last year in September when they surprised with 50 basis points of a rate cut. It's not in markets currently. But if the unemployment rate goes up a little further from here, that becomes a real possibility, because I think the Fed does not want its forecast of 4.5% unemployment rate to actually materialize. They want to put in place an insurance to make sure that that actually doesn't happen. So this is really a rate cut speculation ultimately, I think. And it is notable, as we talked about previous time, that how the tone starts to shift from one Fed member to the other member, like I wrote today, like dominoes, like it sort of goes from one to the other. You have Moussalem today, who's kind of hawkish. He may have a different tone. You have Goolsbee next week. He's also a voting member. He may start changing his tone too. Before you know it, we have a full majority of Fed members ready to cut rates before the meeting starts. So I think that's how it'll play out.
Yeah, and John, we haven't had a chance to talk since the jobs report, which, as we know, came out worse than estimated. We got CPI also coming next week, which could be really telling here. So what do you think all of this means for September?
Well, I think the market's getting ahead of itself, frankly. I think, to me, the key comments that came out from the Fed since that jobs report was John Williams, who is part of Jay Powell's inner circle. And he said, in his view, the job market was still relatively solid and they want to see more data before they make a decision. I think that the Fed doesn't want to get pinned down to September. I think they certainly don't want to get pinned down to 50 basis points in September. Look, they did that last year, and it seems to have been a mistake. They seem to have moved too aggressively last year because inflation stopped falling. Literally, the month that the Fed did that 50 basis point cut, that was the low point for inflation so far in this cycle. So, I think we're one bad inflation print away from them saying, oh, well, wait a second, maybe we shouldn't get ahead of ourselves on this rate cut talk.
Well, we'll see what CPI says next week. Unless we forget, we will hear from Chair Powell in Jackson Hole later this month as well. Ben, John, got to leave it there. Thank you so much. Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst. First up, President Trump set to sign an executive order allowing crypto and private assets in 401ks. What does it mean for the digital asset industry and beyond? We'll discuss. Plus, aerospace startup Firefly is set to begin trading today. We'll go live to the NASDAQ for an interview with the CEO. And Lyft is taking a hit as it shows signs of losing market share. We'll sit down with CEO David Risher to talk about the company's growth. All that and more coming up on Market Catalysts. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of markets here. We've seen things actually come down quite a bit from the highs of the session. The NASDAQ earlier was gaining more than 1%. It's cut that in half right now. The S&P 500 only up about 0.1% at the moment. And the Dow is trading lower by 225 points. That's off about 0.5% here. So quite a change from what we had seen earlier in the day. President Trump expected to sign an executive order that will allow cryptocurrencies and other alternative assets into 401ks. A White House official confirmed that to Yahoo Finance. Trump has been a champion for the crypto space since returning to office, hosting Crypto Week last month, signing into law the first bills to regulate stablecoins. So what does all of this mean for the crypto market? Robbie Mitchnick is here with me, BlackRock head of digital assets, and of course helps run IBIT, which is the now gigantic spot Bitcoin ETF, also ETH, which is the Ethereum one. Good to see you again, Robbie.
Yeah, thank you, Julie.
So this is so interesting, this 401k, this expected 401k change that would allow crypto in 401ks. You know, as we've been talking and as I've talked to the industry over the past couple of years, adoption has really been a cornerstone of what the industry has been pushing for to expand the reach of digital assets, to expand prices. What is this 401k thing going to mean for crypto?
Sure. Well, we are believers, obviously, that there is a role for Bitcoin to play in portfolios as a potentially unique diversifier and hedge of certain sort of left tail risks that exist in the portfolio. And so this, as an extension of the ways that investors are able to build their financial assets and build portfolios that include that, we think that's a positive thing. Obviously, it needs to come alongside education, just like everywhere else that investors participate in this space. That role in portfolios we think is appropriate at a modest level, where that diversification effect can still be a benefit. And so it's an encouraging development if so.
Is this a sort of step change, do you think, in adoption of crypto? I mean, 401ks, obviously, it's huge. If we're talking, if you put crypto into every 401k, that would be enormous. But what do you think that sort of pace of adoption could potentially look like?
Well, as you said, 401ks are a big part of how investors hold their assets. And one of the things that's interesting about this in particular is Bitcoin has been the top performing asset in the world the last 10 years. And a lot of investors, if you're holding it outside of a taxable or in a taxable account, outside of a tax exempt account, there's been a lot of accrued capital gains that have been incurred. And so one of the things I think some investors will be excited about for this is being able to potentially have this moved or held in a more tax efficient way.
You mentioned education being a big part of this, and I know you do a lot of that. At this point, now that crypto has become more institutionalized, more part of the zeitgeist, I guess.
Sure.
At this point, what are people asking you the most? What are they most worried about when it comes to crypto?
Well, I think there's a lot of confusion in the market over how to think about this in the context of portfolios, in the context of this idea of risk on versus risk off assets. That continues to be probably the number one thing that we hear questions from our clients about. As it pertains to Bitcoin, that is a fundamental question that's going to dictate how this is used in portfolios in the future and how widely adopted it is. Because if it is in fact a uncorrelated diversifier, which we believe based on its fundamental properties, that actually is the most logical conclusion, then it's a really interesting asset for all kinds of portfolios, right? Whereas if it's viewed more as a sort of risk-on, equity-like instrument, that's going to be in a much smaller niche of the market that's actually adopted in. So I think there's a lot of education to do to clarify that, because as we've talked about, it's a global, scarce, non-sovereign asset that exists outside of the sort of country-specific economic, political, fiscal risk. But I think the market is early in sort of wrapping its head around that behavior and that nature of it.
Well, and it does trade along with equities frequently, right? Not always,
Sure.
but frequently. And is the trap that it risks falling into is that if people believe it is a risk correlated asset, it becomes a risk correlated asset because they trade it in that way?
100% perception can influence reality in this space. There's no question about it. I think what we see is that there's really two layers to this market. The top layer, which trades with a lot of frequency, tends to be more short-term, more retail, often trades with leverage. There's a speculative component of that for sure. They tend to view it more like equity. And so they'll sell it off alongside equities in the short term. But the bottom layer, which is actually bigger in this space, it just trades a lot less, more institutional, ultra high net worth, they view it more fundamentally from a long-term buy and hold perspective as this diversifier and potential hedge. And so we see this pattern over and over again. Short-term market dips, Bitcoin tends to dump with it, and then pretty quickly and pretty consistently, you see it actually come off that.
So how should we think about the prospects for a Fed rate cut and whether that will affect Bitcoin? I've certainly talked to folks in crypto who have said it should help Bitcoin prices in the short term.
Well, I think that Bitcoin and frankly all of crypto is very much short real interest rates, right? So it has inverse exposure to real interest rates, which means if we do see nominal rates go down, typically you'd expect that to help it in the same way that it helps gold and emerging market currencies when U.S. rates fall. And so certainly that's something that the market's going to be watching.
I also this week talked to another crypto investor who said if we look at Bitcoin as having 4-year cycles, that doesn't bode well for 2026. What do you think?
I think the halving cycles are frankly probably obsolete to the extent that was a driver of those 4-year cycles. If you think about the amount of Bitcoin being mined today, it's a tiny fraction compared with some of the other forces that are in the market today, including the ETFs. It's sort of this fundamental source of new adoption and demand.
So you think we've moved past those cycles?
Well, from a halving perspective at least, I think the impact of that has basically gone to pretty close to zero, because you think of the change in the newly mined supply that's going to happen in the next halving event, it's frankly immaterial compared to what it's been historically, as it keeps being cut in half every 4 years.
I want to ask you about tokenization while I have you here, because that's sort of the next new buzzword in the crypto industry broadly. You guys have a tokenized product. What role do you think that's going to have going forward? And what do you there too? I would ask you the education question, because I'm still wrapping my head around tokenization and what it's for and what it means.
Yeah. Well, I think that we're still quite early days in the evolution of tokenization. The tokenized fund that you alluded to is about $2.5 billion in AUM today, which isn't that big in a global context. Still, that makes it the largest tokenized fund in the world. It's a tokenized money market fund. And so what we're seeing is a much higher hurdle to adoption, to sort of migrate from the old legacy system and to move to this whole new paradigm with digital asset rails and wallets and settling over blockchains, and we're still quite early in that. Now, one of the things that's driving excitement in Ethereum over the last 6 weeks or so is a sense that maybe we're starting to see an acceleration of tokenization activity, and that plays well into Ethereum, just like the excitement around stablecoins does, as a venue where a lot of that activity can happen.
I guess my biggest question for tokenization is, what problem does it solve for?
Sure. So let's take the example of a tokenized money market fund. What it does is break a trade-off that investors historically had to choose between of liquidity versus yield. If you wanted to have cash on hand to make a payment at any given moment, you had to hold some in that way and sacrifice on yield. Whereas if you wanted to hold a money market fund, they're still pretty liquid. You can get your cash back end of day, but it's not the same as in the moment. And so when you talk about tokenization of a money market fund and pair it with a stable coin, you actually create the opportunity to be able to hold a full yielding vehicle. And then the moment you need that liquidity, the moment you need cash, whether to make a payment or to settle a transaction, you can convert it 24/7 to real time. And that's a really powerful breakthrough.
Okay, we're going to keep talking about this next time. But Ravi, thank you for being here. It's
great
good
to see you, Julie. Thank you.
We got much more markets action coming up. Stay tuned. You're watching Market Catalysts.
All right, welcome back to Yahoo Finance. I'm Yahoo Finance executive editor Brian Sozzi here at the NASDAQ in Times Square, tracking one of the, what it may just turn out to be one of the hottest IPOs of this year. That is Firefly Aerospace. really, the company's seeing a price around $45. That's the IPO price, raised about $870 million. Here with me now is Firefly Aerospace CEO Jason Kim. Jason, what looks to be a very strong response. You got the whole team here in the background here. I mean, clap it up, guys. Come on. It's a big day for you guys. There we go. Here we go. Talk it out. So, Jason, they're clearly enthused. This is your team. They've worked very hard to get to this point. For those investors not familiar with your story as a company, I mean, why do you think you saw such tremendous demand on the roadshow?
Well, this company's not aspirational, it's operational. We've got orbital flight heritage on our Alpha rocket. It's done a 24-hour launch for the Space Force. That's set a gold standard. That's going to be really important for Golden Dome. And then we're working on a 16-ton reusable rocket that's going to be launching commercial satellite constellations, national security space launch constellations, missions to the moon. And also we have a Blue Ghost lunar lander. It's going to do annual missions, and then we're going to ramp up those missions even more because you heard Secretary Duffy talk about putting nuclear power plants on the moon. Well, we're the first and only commercial company to successfully land on the moon. So we'd like to build up the infrastructure on the moon, make the moon more frictionless for everybody else to use it, because everything is going to go to the moon and through the moon in the future. And then finally, Electra. I'm really excited about that spacecraft. That's a spacecraft that every spacecraft manufacturer would die for, but we have it at Firefly. It's got our Spectre engines. 8 of those Spectre engines helped us get to the moon and then successfully land on the moon. We're putting that on every single Electra spacecraft. And it's going to be very important for things like space-based interceptor hosts, space domain awareness, planetary imaging, and long-haul communications.
How hard is it to put a nuclear reactor on the moon? Why do we even need that, Jason?
Well, you know, if you want to sustain life on the moon and then eventually go to Mars, you're going to have advanced technology that you validate and qualify before you use it. The moon has regular shots at the moon. We can get there regularly, frequently. We can qualify and validate those technologies. Everything needs power. Then you need communications. Then you need position, navigation, timing. Then you need imaging. So it goes further and further. So we're doing our part to keep America at the forefront, keep America first on the moon. If we're first on the moon, we're first in everything.
Tell us a little bit about your backstory. I mean, you're still relatively new at Firefly. It is a big day for you, of course, too. But what is your resume, and what are you bringing to the table as CEO of this company?
Well, it's like dog years. I've been here for almost a year, and it's feels like a lot more.
20 years.
Yeah, but you know, I first fell in love with this company when I was part of the Victus Nox mission. I was the satellite for that mission, and I just saw the culture, the people, the can-do spirit, the calculated risk-taking, just the rapid decision-making, just overcoming obstacle after obstacle. And they absolutely nailed that 24-hour launch. And so it's hard to not fall in love with a company like Fly.
Where do you fall in terms of, I mean, there's other competitors in this industry. Naturally, SpaceX is the one that always comes to mind. What is your niche, and how do you take do you view it as a competitive battle for market share with the SpaceX?
Well, we're very complementary of each other. I think SpaceX really plowed the field for the rest of us. They really changed the public mindset of fail fast, fail forward, learn, continuously improve. So companies like Firefly, we're doing more of that, and you know, we're going to rate up our Alpha launches, we're going to rate up our Eclipse launches, our Blue Ghost lunar lander launches, as well as our Electra launches. It's really just, there's no one-size-fits-all rocket on the market. It's kind of like your t-shirts. Some people wear small, some people wear medium, large, XL. One size does not fit all, and you can see that in the, at sea transportation, air transportation, and in space transportation as well. So we deliberately chose at Firefly the small to medium, 1 ton to 16-ton market, and it was a really great choice.
Right off the jump in your prospectus, you call out, $1.1 billion in backlog. Help us understand that number. When does that get realized, and how is that going to shape your financials looking out over the next few years?
Well, it's all about our people's execution. You heard last Tuesday on 29 July that we just got awarded our 4th lunar lander contract. It was $178 million. That increased our backlog from $1.1 billion to $1.3 billion. So you can see our team is focused on execution and what they're capable of doing. When we give them the guidance, the support, the resources to do their jobs, they're knocking it out of the park.
When do you think you will hit profitability?
It goes back to we're rating up, and as we rate up and we have more launches and we have more lunar landers and more Electras going up there, we're going to hit profitability.
In the first Trump administration, they brought Space Force to life. Now
Absolutely.
Now it's starting to take more of a shape. How important is that initiative by the administration in terms of what you do and in terms of your business model?
It's extremely important. Being a veteran myself and serving in the Air Force and being a part of the early legacy of the Space Force, I'm a big believer in the Space Force. I think it was a smart move by the president, and now it's taken off with things like tactically responsive space. You're going to see more of those. You see the budgets out there for 2026, they're increasing the tactically responsive space launch budget line. If you look at Golden Dome, that's a big program. Who did we launch Victus Nox for? We launched it for General Gutlein, who's the Golden Dome czar that was confirmed, General Gutlein. So he knows what Firefly is capable of. He's going to see more and more from us as we go public and we supercharge and accelerate our growth.
You brought up a very important point at the top. You view space as a national security concern. Talk to us about that.
Well, space is something that we're all dependent on, and it's undeniably contested. There's U.S. rivals that are doing things in space to take away our freedom of action in space. That's taking away our freedom on Earth. And so it's extremely important. Space is really hard. LEO, MEO, GEO system is really hard.
Man, I'm going to send a rocket and go to the moon. Who else is doing that stuff?
If you have faint of heart, don't go into the space business. It's really, really hard. But that's why we have these bold Fireflies. They do the hardest things in space. We want them to do more of that. And so space is hard, but landing on the moon is even harder. You've seen that with multiple attempts.
Are you hop in here real quick. Are you already thinking about landing things on Mars?
Everything that we're doing on the moon, everything that is going to go into space for space exploration is going to go to and through the moon. And so, all this technology is extensible. We talk about at Firefly, as long as we execute, we could always do bigger and bigger and bolder missions.
Mm-hmm. Your team went quiet here. I mean, this is your big day. Come on, guys, let's go. There we go. Jason, they're cheering you on here at the NASDAQ. Where do you think the stock's going to open before we let you go?
The market's going to tell us, but we've seen growing strong conviction and engagement from investors. We see a lot of demand from our customers. There's way more demand than supply right now, and that's why we're rating up and we're going to execute and we're going to deliver.
Well, we're glued on that open here at the NASDAQ and on the Yahoo Finance platform. Jason Kim, Firefly Aerospace CEO. Good luck on your journey. No pun intended. I just had to do it. It's all real time. I'm not writing this stuff down, Jason.
Yeah, space will be more flying now.
There we go. All right, do stick around. Much more ahead on Yahoo Finance.
Now time for some of today's trending tickers. We are watching Dutch Bros, Elf Beauty, and Ralph Lauren. First up, Dutch Bros lifting its total revenue forecast for the full year. The coffee chain shares are surging by 18%. JP Morgan analysts noting strong same-store sales, defying what DataSense indicated. William Blair saying the company continues to benefit from strong seasonal beverage lineups, healthy rewards trends, rising mobile ordering, and effective advertising. Next up, Elf Beauty declining to give an outlook for fiscal 2026, citing a wide range of potential outcomes related to tariffs. The company did provide guidance for the first half of the year, seeing adjusted EBITDA margins of approximately 20%. That's down from about 23% in the first half of fiscal 2025. Those shares down 13.5%. And finally, Ralph Lauren raising its annual revenue guidance as it benefits from higher demand. Still, that is being overshadowed by the retailer's cautious outlook on the consumer, saying it is unsure how consumers will respond to tariffs and price hikes in the second half of the year. Ralph Lauren has been a standout among U.S. apparel companies, managing to steadily increase prices in recent years, even before the tariffs hit, while amplifying its offering to handbags and women's clothing and attracting more shoppers who skew younger, female, international, and are less price sensitive. Those shares falling 8% today. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, continuing jobless claims ticked higher this week, hitting levels that haven't been seen since 2021. Paired with a weaker than expected jobs report, concerns that the U.S. economy could be weakening and consumers could be spending less on things like eating out. With that in mind, Yahoo Finance took a deeper look at how to play the restaurant sector.
Names in the restaurant space are in focus this earnings season. McDonald's reporting second quarter results on Wednesday, providing key insight into the industry for investors. McDonald's posted a beat on the top and bottom lines and reversing its U.S. sales slump. We're navigating how to play the restaurant sector with the Yahoo Finance playbook. And joining me now, we got Andy Barish, Managing Director of Equity Research at Jefferies. Andy, always good to see you. So let's start there with McDonald's because they reported, Andy. Investors seem to like what they heard. I see the stock's up here more than 3% in today's trade. I know you like this stock. You're a believer. What did you make of the print, Andy?
Yeah, good afternoon, Josh. Thanks for having me again. Really solid and just kind of building layers and sustainability to the U.S. same-store sales, I think was kind of the theme, even if the lower-end consumer continues to not be great. If McDonald's is winning on value and everyday affordable prices, they are going to be a share taker and will continue to drive those solid and accelerating same-store sales in the U.S., which should continue to drive the stock higher.
Andy, in my house, McDonald's is a hit. My 6-year-old is a fan. In terms of product momentum, does McDonald's, Andy, have new product in the pipeline? Is there innovation coming that's going to excite that 6-year-old?
Yeah, this brand's as relevant as it's ever been, and you're going to see in about a week or so kind of a nostalgic return to McDonald's land and some of the characters that maybe you and I grew up with, the Grimace and the Hamburglar, and some interesting innovation around beverages, meal deals. Clearly, the chicken snack wrap that launched about a month or so ago has been performing very well at a $2.99 price point. We'll probably see, Chicken Big Mac make its return in the fall. And yeah, a lot of innovation that, continues to focus on chicken primarily, but also potentially some beef items as well as beverage items that they'll be testing, as we work our way into the end of the year here.
There's a broader question, Andy, I had for you relating to your space and some of the names you cover, like McDonald's. When RFK Jr., Andy, was nominated and then approved to lead HHS, there was a lot of hot talk, Andy, including I remember some analysts who came on the show who said, oh boy, if you are making salty, fried, delicious food, Andy, you might have some problems here. What happened to all that? Was that ever a legitimate risk for investors?
Not really. That's, seemingly been focused on the food manufacturers and obviously certain areas like colorings and dyes and things like that. Restaurants, did come into the scope of the GLP-1s 2 summers ago in the summer of 23. And there certainly was some impact on the stocks. They did bounce back, kind of that fall, but and we really haven't seen any noticeable changes in operational trends or anything as GLP-1s now approach, I guess, about 5% of the population. So we'll have to continue to monitor that. But no, the Make America Healthy Again has kind of kept away from the restaurant industry, given the choices and variety that restaurants provide. And, the GLP-1 saga will continue to see unfold. But, overall, chain restaurants continue to gain share, and the category overall gain share in total food dollars when you include, food at home and food away from home.
Andy, we talked McDonald's. Here's another name, Dutch Bros. Earnings on deck. I'm curious what you expect to hear there, Andy, and why you say that one's also a buy.
Just a company that's really had a great concept and culture, and now has kind of added to the management team and really built kind of sustainable sales layers that are winning in the marketplace. It's focused on cold convenience, customization, and most importantly, maybe it's broistas, as they call them, making connections with the guest and kind of brightening that guest day, in addition to serving them a fun, customized drink. So I think the category's got a lot of growth and tailwinds. Dutch Bros is approaching the category in a way that continues to win, and I think we'll see, a continued sort of beat and raise scenario tonight, as they've had a lot of momentum in the business and a lot of sales layers that should continue to drive, good results. Some of the best unit growth in the category as well. Looking out to 2026 and beyond.
Andy, here's another one I need your take on. Very curious. Starbucks. There are a grand total, Andy, of just 5 sells on the street when it comes to that name. You're one of them, Andy. How come? How come Starbucks is a sell here?
Yeah, we just think it's been really hard to kind of get your arms around the numbers. There are no guardrails or guidance just yet. We really respect Brian Niccol, but I think this was a situation where a lot of the investment community kind of got a little bit excited ahead of any of the results. And what's become clear, we initially downgraded the stock and, kind of went from 110 to 80. We upgraded it at 80 to a hold. When it got back to 95, we went back to an underperform. And I just think it's sort of expectations have gotten ahead of the reality that this is a difficult foundational, operational, cultural turnaround that eventually will take place. It's just needs to kind of, build some baseline before you can kind of see this business grow again. And we're still kind of searching for what that earnings bottom may be. And when you're going through that, it's just hard to value the company and hard to really, kind of buy into the turnaround just yet.
Andy, always great to see you and to have you on the show. Thank you.
Constellation Energy beat profit estimates in its second quarter thanks to strong demand for power and lower expenses. It also reaffirmed its guidance for the full year. But despite that performance, the shares are under pressure. Here with a look at the results, Sophie Karp, KeyBanc Capital Markets equity research analyst. Sophie, it's good to see you. Now, we should mention the context here. The shares are up more than 50% this year, and Constellation has been a pretty consistent outperformer. Was there something in the earnings or the call itself that you think is giving investors pause today?
Hi, good morning. Thank you for having me. Yeah, I think you're exactly right. The shares are up substantially. They are outperforming the market substantially over any time horizon you want to pick. And we think it's just what we've seen consistently is just profit taken around earnings. The results were a little bit ahead of expectations. There was no major announcements on these results, but I don't think anybody was expecting it, just given the timing of the last large announcement. And for all intents and purposes, this was a quarter that was business as usual. And I think we just seen some profit taken by investors who are heading into late summer and looking at the stock that has outperformed substantially year to date.
And Constellation, like many of its peers, has gotten this bid because of deals it's been signing with hyperscalers, data center operators to provide power, whether it is through future nuclear, as in the case of some of Constellation's projects, or elsewhere. It has contracts with Microsoft and with Meta. How much is it going to need to continue to sign those kinds of contracts to continue to fuel the gains in the stock?
I think there's definitely expectation that they will continue to sign some of the contracts. There's only so many plants, I guess, that are suitable for this type of contracting, and I think Constellation still has a few of those that could potentially be signed. With that said, the company has other catalysts, so they obviously doing a pretty large buyback program that should sustain the stock on any weakness. They also in the process of finalizing the acquisition of Calpine, which is a large IPP with a diversified fleet, and that should open the door for more deals with a data center or other large load customers. So I think the runway for growth and upside pressure like announcements is pretty long here.
Do you foresee any regulatory hurdles with that Calpine approval?
No, we think that the current administration has been pretty friendly to deals such as this, and there wasn't any indication that there would be any regulatory pressure on that deal.
Sophie, I want to get a little bit in the weeds for a moment. So I'm going to ask you to bear with me and our viewers to bear with me and talk about electricity pricing and also the auction of electricity generation capacity, which got a lot of attention on the call. One of the things that Joe Dominguez said on the call about electricity, he said there's a narrative that's been building up that data centers are entirely responsible for prices going up. You've got to remember here that the narrative is false. And he seemed to indicate this has more to do with cost upgrades to the connection, right? Power generation connection to the grid. Can you talk us through that and what effect that is having on electricity prices?
Yeah, for sure. So I think that the data center demand is what's driving the incremental, demand in the US US load growth in general. It is not comprised a majority of the power demand, of course, as the majority is still residential demand, and we see it as helpful on the margins, but it's not entirely and solely responsible for power prices increases. The cost of infrastructure upgrades and the cost of just the wires part of the bill, right? It's substantial. It could be anywhere up to half of the entire bill, like a third and a half. And of course, that those costs go up, like in line with inflation or maybe slightly higher per year, right? As utility companies maintain those systems and they continue to invest to accommodate this new growth. And what we're seeing from utility companies is that they increasingly shift this cost of incremental load onto the data center customers themselves. So it's not fair to blame data center customers for driving this cost up, because they're increasingly the ones footing the bill, right? And so we don't see that as the sole factor. And the problem, the way we see it, is with US power prices and the market overall, is that we have not built enough generation, right? And the market construct in deregulated markets, particularly, right, in the PJM, where Constellation operates, did not incentivize the new generation build out for the last decade or more. And given the long lead times on new generation, which is understood to be 5-7 years at least, right now for thermal generation, this is a perfect storm where you have even a small incremental demand in the grand scheme of things that come in from data centers, right, pushes the prices higher because there's just been no new builds.
Do you think that we are going to see a boom in new generation construction? I mean, certainly we're seeing some movement on small modular nuclear, although that's also years out, both for regulatory and build out questions. But do you think we're coming into sort of a boom time for construction of this type of generation that then should come online within the next several years?
Yeah, I think that these two types of generation that we can build here to address this long-dated demand is nuclear and kind of SMRs that you're talking about, right? And this just generic CCGTs and gas plants. And I think that the latter is really what we're going to see first, right? Because this technology is proven, it's available. It takes some 5 to 7 years in the queue to get the turbines, but it's something that can be built fairly easily because the operators understand how to build that. SMRs, on the other hand, are unproven. We haven't seen a working prototype in the real world, and I think that right now every hyperscaler, every tech company basically has a pet SMR project that they're trying to tinker with. But I think we are years away from that being actually shovels in the ground and having a working SMR effort in the US. On the other hand, on the CCGT and gas plants, I think we might see the build out. And what we've seen, some announcements already coming out of the kind of consortiums of tech companies, private equity companies, and energy companies is where they're trying to build just that. And I think this is something to watch, because once we see like large scale build out of gas power plants, we will kind of know that this cycle is beginning to mature on power prices.
It's going to be very interesting to continue to watch. Sophie, thank you so much. Appreciate it. Coming up, we're talking to Lyft CEO David Risher about the company's latest quarter and its newly announced partnership with United Airlines. That and much more next. Shares of Lyft recovering some ground after losses when the rideshare provider reported earnings. In the second quarter, Lyft had over 26 million active riders. They spent a record $4.5 billion in gross bookings in the quarter, though sales did come in just shy of Wall Street estimates. Joining me now, David Risher, CEO of Lyft. Good to see you, David. Thanks for joining us.
Good morning. Nice to see you.
So it was interesting to see the sort of turnaround in the shares here with that sales miss, but then the other strong metrics like bookings. I did see some commentary this morning raising concerns about ridership share in the U.S. What kind of trends did you see in the quarter?
So we have our highest share at the end of the quarter since I started, which was about 2.5 years ago, which is wonderful. And I think whenever people talk about share, in a sense, I sort of think they're missing the big picture, which is there are 161 billion rides in the United States people take in their cars every year. And we do, 800, 900 million. The other guys might do, a couple billion. So it's 2 to 3 billion between the two of us. So this is a growing multi-billion-dollar market that grows, mid-teens, quarter after quarter after quarter. You've seen that. We're profitable now. We're cash flow positive. So I sort of think some of the share stuff loses a little the sort of big picture, which is there's so much room in this market for us to do well, and that's what we're doing.
And it looks like you guys are expecting EBITDA to continue to improve here. What are some of the drivers here behind that profitability push?
Yeah. I mean, we've been talking about this for a while now. I always say the same thing, which is customer obsession is what drives profitable growth. So let's look at our customers. Remember, we have two drivers and riders. On the driver's side, we now have a 29-point advantage in preference over the other guys. When you ask drivers who drive on both apps, which they prefer, 29-point advantage for us. It's because of all kinds of things, earnings guarantees, reference letter automation that we've done, or all these different things we've done for drivers. And then on the rider side, never had more riders, never had more active riders, never had higher frequency, quarter after quarter after quarter of growth. Why? Lyft Silver for older folks to get them out and about. Price Lock allows you to put a cap on your, on surge pricing. Our new United partnership, which we just launched, that obviously doesn't show up in today's growth, but that'll show up in tomorrow's growth. So you do all of these things, and you do them well over and over and over again, and that's how you get a profitable company that also generates a lot of cash and turns into be a really strong business.
I'm glad you mentioned United. I happen to be a Mileage Plus member, by the way. So how much do you think that is going to contribute to growth going forward?
It's going to be a great partnership. So we just announced it yesterday. It doesn't come into effect till later this year. But here's what I can tell you. You're going to get miles, United Plus, Mileage Plus miles. And I'm a long-time Mileage Plus guy. I'm stopping myself from telling you my Mileage Plus number because I don't think the security guys would like that. But I know it so well I can tell it to you. It starts 003. Anyway, we'll move on. But the point is, every time you take a ride, whether it's to the airport or just down the street, you're going to get miles. And that is fantastic. That's going to be great for riders. And then they'll get even more miles when they do what we call high margin or high value modes like Black or SUV. It's going to be great. And it's great for United as well because it helps make their Mileage Plus program even more valuable.
I got to ask about autonomous driving because there was some talk that the Waymos of the world are starting to maybe take some share in the U.S. from human-driven vehicles. I know you guys are now doing a partnership with Baidu in Europe, and you're in Europe, by the way. Newsflash, you're in Europe as well. So how quick is that runway still going to be? It seems like it's now, after talking about it for a very long time, finally it's becoming reality. What do you think then the adoption speed is going to be like?
Yeah, so a couple different things there. The first thing I would say is I think this is a great, great wind at the back for rideshare. And the reason I say that is because as autonomous vehicles enter the platform, what that means is that there's a new interesting product, one that's safe, one that's reliable. It does all sorts of really interesting things for people. And we've seen that. So in the markets where we see AVs versus the ones we don't, we actually see something like 5 times industry growth in those markets. So that suggests that it's not just about grabbing share one or the other, it's about expanding the market. And remember, a hybrid network, which is what we're building when you have human drivers and autonomous, means best of both worlds. If you want an AV, get one. If you don't, for any number of reasons, or one's not available, have a human driver. We sort of love that. So if you think about that from a sort of overall market perspective, I think it's only good. And as you said, we just signed a big new deal with Baidu, the world's largest AV supplier, actually, 11 million, I think, rides with no driver in the car. And we're going to be bringing them to Europe, which is wonderful. And then here in the United States, over the summer, we're going to be launching our partnership with May Mobility in Atlanta, and then with Mobileye and some others, Benteler, next year. So a lot of interesting things happening in AVs. It's still very early, but it'll be like one of these S-curve things, where it kind of seems like it's growing and growing, and then all of a sudden they'll be everywhere over the next, call it 3 to 5 years.
Well, we'll keep talking about it, I'm sure. I'm glad you did not give me your mileage plus number. Your security people are very happy for that. David, it's great to see you. Thanks for joining us.
Wonderful to see you as well. You take care. Till next time.
And that's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We got more Yahoo Finance coming up.